Welcome to Real Vision's Trade Ideas. Today we're sitting down with John Kolovos of Macro Risk Advisors. It is great to have you back.
Thank you for having me.
So I'd like to get your take on the current market environment to start out with.
Sure. So equities, boy, I mean, what a pullback we've seen. I think we need to view this pullback within the context of a longer-term uptrend, right? So systematically and objectively, the trend for the U.S. markets, the S&P 500, is still positive. But the way in which the decline has occurred is a little bit troublesome, and we need to keep a very close eye on that.
Okay. So then could you take us a little bit through that historical perspective versus what you see going on today, specifically in equities?
Sure. So as we made all-time highs and approached this 30.65 level that I've been throwing out all year, I think it made sense to be a bit cautious as we were getting to the high and anticipating some sort of pullback. Why? Well, seasonality, it tends to be weak this time of year from July into October. Also, after the Fed cuts interest rates for the first time, markets tend to act poorly for about a month later after the cut, right? So as we're seeing the markets roll over here, we need to view it within the context of what is, I would typically say, normal, right? Weak seasonalities and weak performance after a Fed cut.
And so is this every single time after the Fed did its initial cut? We usually see the markets...
Well, what usually happens is, and what I did was I did an interesting study, is it's like, all right, the Fed's cutting rates for the first time, right? And let's take a look at how equities performed after, but let's separate it from an uptrend into a downtrend. So if equities went an uptrend and the Fed cut rates for the first time, how did equities perform? Well, actually, at 3 months later, stocks were higher, but over the short term, stocks were lower, right? But what's interesting about that is it only happened 4 times out of the 17 observations that I saw. So it's very unprecedented to see the Fed cut rates when equities are so strong. So as markets are coming in, they're behaving in a way that they should, according to that study, and again with the seasonalities and all some other divergences that I'm seeing, but we have to start to study, okay, are we diverging, if you will, from what would be typically normal?
It is a rather small sample size,
Yeah.
though, to have the Fed cutting rates in a strong market environment. I mean, do you see this time being substantially a different environment, though, than possibly previous times? We have $15 trillion of negative yielding debt.
Right.
We have a global economy that's potentially on the verge of a recession. Earnings are potentially slowing down. So do you see this time as being something that could be potentially worse than previous times?
Yes, I do. Back in early 2018, when we had Volmageddon, right, when the equity market came down, I was inclined to buy that almost blindly, right? We were coming from a very strong perch with the equity markets. You know, we had good breadth, good statistics, technically into that high. You wanted to buy that pullback, okay? And then now what we're seeing with this pullback, there are a lot of divergences going on underneath the surface, which has me a bit concerned. What are the divergences that they are? Well, let's see. The S&P is at an all-time high. Financials aren't. Industrials are not at an all-time high. Small caps are not at an all-time high. Global markets have rolled over significantly. Emerging markets are in a bear market. They can't get out of their way. Same with Europe, right? Europe looks like a big, massive top formation, right? So global breadth is weak as markets are coming down. So it is concerning, you know, with this pullback, say, okay, as we come down to these support levels, we need to be very respectful of them.
What do you see equity markets doing in the medium term? Is it sort of a muddle through for the time being? Is that something that you want to be in, be out of?
Okay, so on a longer term basis, I'm still positive on the equity markets, right? 30.65, I think, is the central tendency for this year. I think we can still work up there, right? But this is where we have to thread the needle a little bit, right? I'll maintain that bullish view so long as the June 3rd lows on the S&P 500 holds, okay? Or you want to keep it real simple, that's approximately where the 200-day moving average is. That is huge. I'll maintain my positive view for equity so long as we stay above, let's say, the 200-day moving average. It's a very simple proxy for trend, but it's incredibly useful. So as long as we stay above it, I still think the trend for the markets will stay higher. But what's incredibly important to consider with the break of the 200-day moving average, if we do break below it, we tend to go into an environment of lower for longer. It doesn't necessarily mean we're gonna, crash or something like that. But it does mean that we need to base out and to, kind of go sideways for a little bit and get our bearings before we start pushing up higher.
Okay. So then in terms of the equity markets, maybe it's something that you're a little bit cautious of, right?
Yes, I am cautious on that. And there's one other scenario I know I forgot to mention about why this is a little bit different than other pullbacks in the past. The S&P is following a pattern very similar to what we saw in the 1970s. I call it the bell-bottom blues chart, okay? Named after a great song from the Derek and Dominoes in the early 70s with Dwayne Allman and Eric Clapton. Great song. But it's a bit worrisome. And the analog is quite striking to me in that back in the 70s we saw higher highs and we saw lower lows, okay? We're seeing that now with the S&P 500, right? It almost looks like a megaphone, if you will, or broadening formation. They represent extremes in bullishness and bearishness, right? Extremes in sentiment, right? And how people feel about the environment. And what that means is that they tend to be trend killers, okay? They tend to put an end to an uptrend. And the implication of which, if I am correct in saying that this 200-day moving average is important. If it gets violated, my suspicion is we'll undercut the December lows, around 2350 in a hurry. So we could be down peak to trough 20% by November if we do not hold these levels. So it's incredibly important that we maintain the June low or the 200-day moving average. It's very, very important. It's also interesting in my mind with that analog, it's not just the visualization of it, right? Think about what was going on in the 70s and what's going on right now. And I think the most important one would be the love affair that everyone has now with growth stocks, and you had it back then in the 70s. You had the Nifty 50 then. Now you have the growth stocks, the FANGs and what have you. It's that to me is just staring me right in the eye. And the other thing would be is that back in the 70s we had a president that was going after the Fed. Today we have a president that is very critical of the Fed. Also, there were issues with OPEC back in the 70s. Of course, we got him right now. And instead of having a Cold War with Russia, we're having a bit of a Cold War, at least on a trade front, with China. So there's not just a visual similarity, but I think from a society standpoint or a social standpoint, there's also those comparisons.
How do you see the bond market faring in that sort of scenario?
Okay, so I think the trend for rates is lower, okay? And I think we have to stay with the trend, for lower rates. But I'm gonna put a big asterisk on that. And this is hugely important as well because equity markets and interest rates have correlated with each other on a 26-week basis since 2000, okay? So if interest rates go down, stocks should go down and vice versa. So this decline that we just saw in interest rates has brought them to the most oversold level since 2002 on a weekly basis, okay? And maybe like the 15th most oversold interest rates have been since 1980, right? So what that's telling me is this: we're getting close to an important inflection point for interest rates. We could go down a little bit lower. I have an objective somewhere around 160. I wouldn't be surprised if we drift a little bit lower towards 150. But over the next 8 to 12 weeks, we should see interest rates start to plateau and start to move up higher.
So then in this potentially risk-on environment, what do you see happening to gold?
So gold, there's two things going on with gold. There's a long-term breakout for gold, which implies 1,800 on gold, okay? Big base breakout, technical, breakout, everyone likes it, and it's true, it's a good breakout. But on a short-term basis, I think gold can pull back and consolidate here right now, and same with silver. Silver, actually have more conviction on a silver pullback than on the gold. Silver has lagged the price action of gold up to this point, and if you look at the longer-term chart of silver, it's bumping up against resistance here right now in an overbought state, in an environment where everybody is so risk-off and so on edge that I think a pullback here makes a bit of sense.
Okay, so with all that being said, where do you see the opportunity for a trade in this market?
Okay, so a couple things I have my eye on, right? I think it still makes sense to be cautious on the near term, right? And I think it always makes sense to protect yourself. And I think one interesting trade out there, particularly given that currency volatility is very, very low right now, I would look to be long the yen here.
Okay, and so that would be because of strength in the yen or potentially weakness in the dollar? What side are you
I think I see more of as the yen gaining flows for safe haven, purposes, right? For more of the risk off. So to protect myself, maintain being long, the yen, thinking we get down to about 103.5. Okay, on an intermediate term basis, but no, I would maintain being long the yen in this environment here right now.
Okay. And that being a safe haven asset, how do you justify that with the idea that we might be in a risk-on environment?
Well, I think it's just good. It's more like a hedge. Okay. I think it just makes sense. So the way that, again, I keep going back into how the equity market had declined very quickly. Okay. That's the market's message of telling us, hey, something's going on. Okay. And let's pay attention to it. One interesting study I did recently was to take a look at when the S&P 500 declines through the 50-day moving average, all right, and then did so when the 1 week rate of change was already 5% or worse, okay? And what I found there is that while returns are slightly positive going forward for the next 3 months or so, the downside risks are very, very high. So what that means is, from a trend standpoint, we could be reversing. So I think a yen trade, right, would make sense in the context of also low currency volatility. So if we get into a trade war with China, right, currency volatility is going to rip and accelerate. And I think the yen is a good way to play it.
Interesting. So then what would be your time horizon on this trade, and can you review your levels again?
So the time frame for the yen would be about 2 or 3 months. Thinking about 103.5 is my initial objective there.
Are there other sectors or other commodities or other areas that you're looking at to trade right now?
Oil.
Okay.
I think oil is in a secular bear market. I think so long as oil stays below $60, I think it's a sell. Be looking to selling it here, pressing shorts below 50. Ultimately thinking that we do get underneath the December lows, 38 or so, over the next 6 months or so.
Would you put a stop on that?
$60.
$60, okay.
Yeah, I'll just maintain the bearish view on it so long as we stay below 60.
Wow.
And then the only risk there to that would be what's going on in the Gulf, right, with Iran, right? I think there's that risk that there's an accidental war or something along those lines where oil could spike. But you just look at the secular trend, it's down. So even in the 90s, when we had the Gulf War then, oil did spike, but it still was within the context of a secular bear market. From that era, I would still view oil, even if we do get a spike, hope not for that reason, but it would still be within the context of a secular bear market.
And what is your time horizon for that trade?
So the trade would be, 6 months plus. It's more of a longer term view. If you want to say 6, that's fine. But yeah, longer term, making new lows on oil.
And would you be doing this through the futures market or?
Futures, right? You can also use the USO, which is an ETF. That could also be a good way to play it. And akin to that would be the energy sector, XLE, right? I think oil makes that sector uninvestable on a relative basis.
All right, can you review your general market thesis as well as specifically your view on oil and the yen?
Okay,
30
so
seconds.
you got for 30 seconds. You got
You can do it.
All right, so for equities, right? I think on a long-term basis, you need to maintain your positive view so long as we stay above the June 3rd lows or the 200-day moving average to keep it really, really simple. Still looking at around 30.65 as your potential upside objective. All bets are off underneath that level. We wind up falling into that bell-bottom blue scenario where we have a quick decline lower on stock. So critically important there, okay. In terms of the yen, since currency volatility is very low and there is a heightened risk of lower risk assets, if you will, I think it makes sense to be long the yen down to about 103.5, okay. And then finally, when it comes to oil, oil secular bear trend is in place. Momentum has reasserted itself to the downside. Would look to play yen on the play oil to the downside to at least 50, if not lower to new all-time lows to about 38 or so.
Great, John. Thank you so much for joining us, and we'll have you back soon to give us a little bit of an update as to where things are going.
Thank you for having me.
So John is bullish on the yen. Specifically, he likes buying at current levels with a target of 103.50 over the next 2 to 3 months. Since the interview was recorded, John has updated his stop loss to 108. Additionally, he likes shorting oil at current levels with a target of $38 over the next 6 months and a stop loss at 60. Just remember, this is a trade idea and not investment advice. Make sure to do your own research, consider your risk tolerance, and invest accordingly. For Real Vision, I'm Justine Underhill.